Everybody, Brian Shannon here. It is Saturday the 28th of March 2015. Let's look at our market. This week we did lose some ground for equities. The only thing green here on our screen was oil, which bounced back 4.3%. And let's go ahead and take a look. The S&P 500 actually was down for the year on Thursday. It was only Friday's small bounce that got us to back to positive year to date. So we're seeing a pretty volatile market so far this year. We had, of course, seen a big range first month and a half of the year, and we had broken that, made a nice headway, and now we're back to a little bit of a range once again here. We saw a lower high for the S&P 500, and now we did slightly dip below and make a lower low, and as we often see when that happens, we got a little bit of a bounce here after that cheap new low, but there's nothing here that's really encouraging going into next week as far as looking like probable long side opportunities. We do still have a declining 5-day moving average, so this market is guilty till proven innocent. And looking at the daily time frame, of course, we have that 100-day moving average that we dropped down through as well. So it seems to me, unless we start to really see a little bit further consolidation and the market can hold in this general area, I mean, we may get a bounce up towards that declining 5-day moving average. But until we see that 5-day moving average flatten out once again and we start to see higher highs and higher lows above it, you have to remain very cautious towards this market going into next week. It seems as though, to me, a 61.82% retracement of this year's range down at 203.51 is pretty reasonable in the near term, and I think that would cause a lot of people to wonder whether or not this market is really going anywhere this year. But of course, we've just ended the first quarter rather, and we've got a long way to go for this market still. For the Nasdaq, we lost ground, of course, this week as well. We can take a look here at the numbers and see that we lost 2.77% for the Nasdaq 100. And, this market was behaving better. It had bounced from the rising 50-day moving average, and here we are once again at that 50-day moving average, but below it. So, again, a 50-day moving average doesn't mean it's a place to buy. It means a place that we consider that we want to look at shorter term time frames to see if there's evidence that the buyers are regaining control. And right now, that's just not clear. We saw a little bit of a bounce after Thursday's gap down. We closed negative that day, and we closed with a very small gain, just 42 cents on Friday. So again, with a declining 5-day moving average going into next week, it's guilty till proven innocent. We need to let this market give us some time to heal or reveal to us whether this market is going to pull back a little bit deeper. We did touch the volume weighted average price year to date as our low this week, so that's kind of interesting to note. And here's our range year to date. That was right around the 50% retracement as well. We also came down to the 100-day moving average and found a little support there too. So there's nothing here that says the market will bounce. This is, of course, a level that's been important as far as resistance and now is trying to hold a support. Trying to hold a support doesn't mean that support has been found yet, though, because we still have that declining 5-day moving average, so don't rush into things here. The Russell 2000 obviously lost some ground this week as well. We were very cautious about it as it was extended and it was getting up towards, we talked about this trend line in the 5-day moving average. But breaking this support is what I had told subscribers that, if we break below that and hold below it, then it seems as though a bigger correction in the Russell 2000 may be coming. And, we've seen this before, that these markets, when they break out a lot of times, that the breakouts fail, and then we've got to either give them time to see if they're going to hold. We are still above a rising 50-day moving average here, and we can see that the trend line for this year so far is still holding, at least on a closing basis. But with it below a declining 5-day moving average, it is simply not something to trust, especially when we saw that the market was down on big volume on Wednesday, and we saw volume diminishing on Thursday and Friday. Only price pays, but it does give us a clue that the buyers aren't as aggressive getting back into the market as the sellers were getting out. We can also take a look at the volume weighted average price since the event, of course being that gap lower on Wednesday, and we are bullishly holding just above that, so that's good to see. However, with a declining 5-day moving average, it tells us don't trust it, not yet. The semiconductors rallied on Friday late in the day, right up to their declining 5-day moving average. And, this market, we had seen a bigger breakdown, and it was maybe you could call it oversold. We've got this level that's been support near 52 to 52 and a quarter this year. But we've got a bounce, and it came right up to a declining 5-day moving average. So I certainly wouldn't want to see anyone chase the market up this, at this level. It just went from 53.70 to 55.70. So 2 points in the last half hour of the day. You have to ask yourself, where has it come from when you purchase? Do you want to buy it up here 2 points after it's up 2 points in the 4% in the last half hour of the day on a Friday? And where does it have the potential to go before it's likely to encounter resistance? And we're at this prior support. We're at the declining 5-day moving average. So I think the most likely scenario for the semiconductors is a pullback down towards at least 54.50, and then we'll see if this market begins to stabilize a little bit better and is able to be sustained, or if this was just a quick rally because of some news. And no one knows the answer. We've just got to give it a little bit of time. And you can look at it and say, wouldn't it have been nice to have caught that? And it would have been nice, but would it have been realistic to expect that to happen? And my answer is no. The financials, these guys broke their important support level. We've been talking about 24.20 to 24.35 as being a bigger band of support. We're going to now look at that as potential for resistance. It's also where we have the declining 5-day moving average. This market has just had a real tough time trying to break beyond this resistance. It looked for a while like it was going to be able to do it, but this is why defense is job number one. And when it breaks down and it's back below that declining 5-day moving average, you simply have to stand aside and say, it doesn't look like the buyers are taking control here. Let's stand to the side, wait for the dust to settle, and then consider a potential long. You don't look at it and go, the market's dumb, the market's wrong. You look at it and say, you know what, I'm going to get out. I'm getting stopped out. We'll see where it goes, but I'm going to avoid bigger losses here. Nothing wrong with small losses. That's part of the business. But if you continue to hold through these declines, or even worse, buy more into it and try to lower your cost basis, that to me is a horrible strategy and something that a lot of people will begin to regret if markets do kind of what oil did, which is, just fall apart completely. And we've seen in oil, here we have this 50-day moving average, which the market is back to and trying to hold a support in there. We've got this prior, this prior level is what we were talking about at about 48.5 to 49 as far as this prior support. It was prior resistance here, held a support. We saw that it did break down below that 50-day with the 50-day moving average declining. It made a lower low in the last week and a half, and then it had a very strong rally this week because of Middle East tensions, or whatever you want to assign the reasons to is kind of irrelevant. For this market to really be considered having a good opportunity to get back some upward momentum, I think you need to see it above these peaks right here at about 54.5 to 55. It's still in a primary downtrend. It's still guilty till proven innocent. It's at best trying to neutralize and create a bottom, but to call this a bottom, we simply don't know. If they don't scare you out on the way down, they will often wear you out as the market begins to correct. So, it's nice to look at it and say, wow, I could have made this, or should have done this on that bounce. But the fact is, we're still down a lot year to date. And if you look at where we were, last year, we're still down 16% year to date in oil. There's nothing here suggesting that this is a bull market or turning into a bull market. Apple remains guilty till proven innocent. It's below its declining 55-day moving average. It's hanging on near the 50-day moving average. As I mentioned to subscribers on Friday, what I think would be actually a nice scenario would be for this stock to kind of, suck in some longs here at the 50-day moving average and then fail, make a lower low, and then head back down towards the year-to-date volume-weighted average price, which is right now at about 120.5. And also we could look at the year-to-date VWAP, Fibonacci rather, and you can see a 50% retracement would bring it down to 119. So right now we're hanging near this 38.2% retracement. I'd like to see it down towards 120 to 119, and I think that would be very healthy for this stock. It is guilty till proven innocent. I had a subscriber on Friday. I had mentioned a short right here for an intraday day trade, and then one of the subscribers said it was getting a short squeeze right here, which is it's just not true. That's not what a short squeeze is. So, anyways, let's take a look at some of the bigger names out there as well. Google is kind of finding its footing, I guess. A pullback down towards this prior resistance in the 50-day moving average seems like it would be likely in a good scenario. Netflix, the volume weighted average price year to date in here, we just broke below it this week. If we take a look at the volume weighted average price since that gap higher, we've been below it for a while. So since really about March 11th, and it just looks like it needs some further correction in here. Tesla, we had a beautiful short in this one in the subscription. So for subscribers this week, we were talking about this one as a short right below this level. Covered half of it on Thursday, and our stop is now going to be down towards 186. So Tesla is still in trouble. It's still in a downtrend, and it's a difficult stock for a lot of people, because we get if you're going to short it, you can't hold short because we can see these rallies from 188 to 205, and then finally when it starts to get back below that 5-day moving average and creating a new pattern of lower highs and lower lows, that's when you want to short the stock. Alibaba, still a piece of garbage, still in a downtrend. At very best, it's trying to create some support, but with a declining 50-day moving average, if you get involved in this stock, do expect the rallies will fail.